Hey, welcome back to the Price Action Labs YouTube channel. So the last video, the audio quality wasn't great, and so I'm going to retake this and just pretend you haven't seen it. And so this was an ES long trade I took on Thursday, the 9th of April. And so I'm going to be breaking down, I'm glad to see we have some follow through on ES futures. So step by step, I'm going to be breaking down this long trade using both footprint charts and candlesticks together. So in this video, I'm going to be going over various frameworks, models, breakout models, order flow based models, and different types of things you can integrate into your trading to help you refine your edge. So let's get into it. So this was the long trade from the 9th of November. So yep, not Thursday, 9th of November. So a couple of things to note with this is that there were three main things which price did, right? Price tapped into a key level. So that's kind of step one. Price tapped into a key level, right? The second thing, price gave an absorption. So I'm going to talk about absorption, right? And then the third thing is price gave us an entry, right? So price gave us what we call a retest entry. Now, these are the three basic things I use, but over the months and over the years I've been trading, I've now come to a stage where I'm refining everything in models, right? Basic step-by-step models that you can use and follow to replicate in your own trading. So let's dive into how I got this trade, right? So for those who haven't watched the channel previously, this trade basically came off a fantastic key level. And so one of the most common questions I get is, how do I find my key levels, right? What systems do I put in place to find my key levels? And so I'm going to break that down simply for people to understand. So when it comes to finding key levels, I will use this over here, right? This is my sort of approach to finding key levels. So with key levels, key levels comes under positioning. So there's 4 P's, I believe, to profitability. The first of those P's is positioning. So it's understanding where you are positioned in the market before you take any kind of entry. That's what we call positioning. So positioning your trades comes down to what I call the 4-step positioning process. And so I've got that right here. So the 4-step, right, S.T.E.P, positioning process comes down to structure, targeted liquidity, equilibrium, price imbalance. Now, these are the 4 basic steps I use to find my key level. So if we take this now to the charts, what we saw from Wednesday, the 8th, was this, right? So let's just take a look at all 4. So what we had over here was we had a structure high, structure low, and then we had our structure high up here. So we had a sufficient pullback, right? Because of that sufficient pullback, I labeled this as the high. So what we're looking for is structure, then we're looking for targeted liquidity. Now, what I mean by targeted liquidity is simply the most recent high and the most recent low. So what it looks like in theory is this, right? Or in practice is this is the most recent low, this is the most recent high at the time. Okay, that's what we mean by targeted liquidity. Now, the next thing with targeted liquidity, or after targeted liquidity, is the equilibrium. So the equilibrium, what you want to do is you want to draw the fib from the low to the high. And so by doing that, you will find that we are in a premium. So we have the equilibrium tells us that all the way up here, we are in a premium. And the final thing we're looking for is a price imbalance, otherwise known as an FVG. So with the price imbalance, it's here. Right, so let me just remove this. There is the price imbalance right there. So this becomes your level, like this. This is your FVG. And for the key level, I will draw the candle before, right? So the candle before the price imbalance becomes the key level. So that's me following all 4 steps, right? So structure, targeted liquidity, equilibrium, and price imbalance. Only then do we get to our key level, right? So I want you to think of this as you need to climb up all 4 steps in order for you to correctly position yourself in the market, right? At the key level. So positioning is the first sort of thing. That's the first thing. So once we have our positioning, right, this then gets us our key level. And so from Wednesday, the 8th of April, this was a key level purely because of the price action we saw here. So I've made a separate video on this, so I'm not going to go over it. But here specifically, and here, we saw that sellers were in control, right? That's why we had the shorts coming down here, because sellers were actively in control. So let me break down what I mean by sellers are in control. So everything comes down to frameworks, right? So positioning, now we're moving on to price, right? Specifically, once you have a key level, you want to read the price action inside the level to make any kind of decision. And so what I mean by reading price action specifically is you need to have a way of actually understanding what the markets are doing. And this is where I see so many traders going wrong, is that they try and use almost any concept other than order flow to try and do it. And there's no way you can read the price action without understanding order flow. So I'll repeat that again. There is no way you can read the price action without having an understanding of order flow, right? So the quicker you can get over this in 2026, the faster your progression will be, right? Just get over the fact that you need to understand order flow and footprint charts, right? It's not some new strategy. It's not some secret fancy tool. It's not a bot. It's not some algorithm. It's not even a secret at this point, right? Footprint charts have been around for years. I am surprised not more people are using them. But generally speaking, footprint charts are the only way for you to read price in the long term, right? Long term means if you want to stay here consistently and have like some kind of consistent results or some kind of consistent understanding, having footprint charts will be the only thing that will get you there long term. So just try and understand that. You don't have to understand that now, but it is what it is. So when it comes to reading price action, right? It comes down to the real-time reading blueprint. And so the word read, of course, is very important. That's why I've put it into an acronym so you can remember. And the phrase real time is important, right? Because the truth is, right, I've spoken to some traders who, what they'll do is they'll try and find a daily bias, right? They'll try and find some kind of daily bias. So what traders often do is they try to find a daily bias, which is not necessary. Even worse, they try and look at the news, aka Forex Factory. Some traders will look at previous day highs, right, and / previous day lows, which is also not necessary, right? And I'll explain why. And what some traders do is they'll use sort of the volume profile, yeah, which is kind of the best out of all of them, but it's still not it's not necessary. Like, you can use it, but it's not necessary. So when you have these things here, daily bias is the most ridiculous thing I've ever seen, right? The reason why daily bias is so ridiculous is that you cannot predict what's going to happen before the market happens, right? You want to have a rough bias for the session, but you want to confirm it with the order flow. Having a daily bias, especially on something like the S&P 500 or NASDAQ or US 30, we can be bearish in the AM session and bullish in the PM session. So having a daily bias is not needed. The news you don't need whatsoever. I hope I don't have to explain that. Previous day highs and lows. Now, I understand why these would be useful. They are useful when it comes to finding certain key levels, but the reality is looking at the previous day high and low will not help you enter any kind of trades. So that's gone. Now, volume profile is interesting. You want to know where sort of the point of control is, but when it comes to understanding where key levels are and where buyers and sellers are sitting, right? You're not going to find that from volume profile. You're going to find that from following the 4-step positioning process and then the real-time reading blueprint. So you don't need volume either. You don't need any of these things, right? Just saying, you don't need none of these things. What you need to understand is once you've followed the 4-step positioning process, you then want to move to the real-time reading blueprint. So what that means is you want to be reading the bid and ask. And so I'm going to get these up side by side. Here we go. So this key level you see is the same as this key level, right? This is now the let's just go to the 5-minute time frame. There we go. So here we are. Here we have the 5-minute time frame. Let's just clear that out. And let's just make this a bit wider. Here we go. So this entire region here, this one. Now, when you look at that region that I've circled, right, what you're looking for specifically is this, right? You want to see this kind of price action. So when it comes to reading price action, first you want to read the bid and ask. Now, I understand the numbers here are a bit small, but there's certain things you want to understand when it comes to reading values on the bid and ask. So that's the first step. The second step, the third step, come together. And what that really means is, if we break that one down, is this. So you want to be reading the bid and ask, evaluating the delta, and assessing aggression. So E and A often come together. So evaluating the delta allows you to assess the aggression, right? So when you evaluate the delta, right, let's kind of break down what that is. So when we evaluate the delta, what we're looking for is where I've circled, right? So what color is the delta? So in other words, what is the color inside the candles, right? Let's start here. It's blue, right? Just here, blue. Now, what does that blue mean? that blue means we have positive delta, and red obviously means negative delta. So inside of this zone, and again, I'm only interested in the price action inside the zone. Why is that? Because our key levels are where we trade from. We want to know if they are demand zones or supply zones. So in other words, we want to know who is in control at that zone. And the only way you can do that is by reading the order flow in the now time, reading it in the real time. Hence why I've called it the real time reading blueprint, right? Because you've got to read this in real time to make any kind of decision. So when we're looking here, what we can see is the aggressive buyers or blue delta, which signifies that buyers are being aggressive. And so that leads on to the A. So the A in I.R.E.A.D is assess aggression. So once we've evaluated the delta or seen the delta, we want to assess aggression. And once we've assessed aggression, we can see buyers are showing more aggression inside the level. We then want to detect zeros. So what do I mean by detect zeros? So what we mean by detect zeros, again, the writing here is quite faint. That's not really the problem here. What you can see here is a zero. There's a zero here, and also there's a zero over here. Now, what does a zero mean to us? Right, what does a zero mean to us? So if we go to the 1 minute time frame, let's kind of break down the execution. So my main execution came after seeing the price action here. I stayed in after seeing the price action here. Okay. Now we saw zeros at both of these ends. And so what a zero represents, if we just kind of break down the blueprint. So read, right? Just remember the word read. You want to read price action. If you want to trade the price action, you first have to read it, understand it, and there's a framework for understanding it, and then you want to execute based on what you've read. You know, simple as that. So first you want to read the bid and ask. So read the bid and ask. That's from the footprint charts. Then after you've read the bid and ask, you want to evaluate the delta. So by evaluating the delta, you're looking at the color inside the candle. So you're looking at, you know, here, for example. That's the second thing. The third thing is you want to assess the aggression, right? Assessing the aggression comes from understanding what the delta's what the delta's telling you. And the fourth thing is you want to detect zeros. Detect zeros. There you go. So this is what READ stands for. Read the bid and ask, evaluate the delta, assess aggression, and detect zeros. So once you do all these four things, you now are reading price action in real time. The real time frame, the real time reading blueprint, right? So when you see a zero here at the top, what it basically represents is that if we just take a look at the bid, right, and we take a look at the ask, what this means is the bid is actually zero, right? And the ask can be, let's say, 100. So what that means is there are 100 aggressive buyers resting here and here, these two regions, right? There are a ton of buyers, but we managed to break lower on 2 occasions. So what does that tell you about those aggressive buyers? Were they successful or were they unsuccessful? They were trapped, right? They were trapped in this area, right? Because if they were successful, they would have broken above this zone, right? But they didn't. So they were not rewarded with follow through. And we call this a finished auction. I just call it detecting zeros. So when you read the price action, what you're doing is you're reading the bid and ask, you're evaluating the delta, you're assessing aggression, and then you're detecting the zeros. This is basically how any reversal forms. Now, once you have your reversal, once you have your confirmation, right? This is confirmation over here. This is an area of supply. Now, once you have an area of supply, you can then start to, just drag that to the right. You want to start dragging all these areas to the right because this is basically how, the market actually works, right? So just remember this, right? When it comes to finding key levels for a session, just remember this, right? Just remember this. So on Wednesday, the market showed us evidence that this was a key level. So a key level you want to think about is where did the absorption take place, right? Where are their buy and sell limit orders resting? Well, we know on ES between 68.36 and 68.28. So this is a key level here. So when price comes into this region, right? Price is going to come back to this region. So this is how I find my key levels, right? So key levels is, there's a process behind it. There's an overall process. So it comes from, trade positioning, understanding price action, right? Reading proof, we'll come on to what proof means, and then precision entry. Now, once you have a precise entry, once you have that precision entry, you don't want to neglect what zone it came from. You want to remember what zone it came from, and you just want to drag it to the left. Right. You want to keep dragging it to the right, because this is what allows you to take good trades the next day as well, by understanding where the level actually is forming. So let's move on to Thursday's trade. So going into Thursday, we follow the same process. Positioning. Now, we already have our key level from Wednesday, right? So this is a key level. I just drag it to the left right here. Now, when it comes to positioning, we've already solved it, right? We've already solved that. Now, all we do in the session, and this is a very important lesson. So I'll break down in real time what the Discord is looking like. So this trade was all about patience, right? So it's understanding the real patience of the market, right? So for example, I posted this. So for example, I had a level here. This was the Wednesday level I just discussed, and I had a couple of levels down here. So the truth of the matter is, this was at 15:18, which is 18 past 10 Eastern. Now, we didn't tap into this level at around 11:30. So I had to wait over an hour just to get an execution at this level. So I planned the level before the session even began. So here, I had to wait until 11:35 just to make an entry, or 11:40 just to make an entry here. All right, so I had to wait over 2 hours just for my level to be here. And so the lesson there is patience to wait for the right level will always win in the long term. Patience to wait for the right level will always win. And knowing how to read price action at that level will always get you to where you want to be. Always, right? Now, if we just kind of break down this is where I'm going to go through all of my frameworks, right? So this is one of my frameworks. Let's go to my other framework here. So first we're looking at positioning. All right. The next thing we're looking at is price, right? So how are we reading price? And so we read price with this framework here. So structure, targeted liquidity, equilibrium, price imbalance. So once you've kind of climbed up all 4 steps, you reach your key level. So this is now our key level, right? So that's kind of step 2. So we've kind of gone through positioning, price, now proof. Now proof is another way of saying confirmation. So the way I see proof is, instead of you going into the market and trying to put breakouts on, lines on, trend lines, indicators, EMAs, even trying to follow the news, you don't want to do any of that. When you take a trade and you're looking for confirmation, the only thing that can give you confirmation is the market. There's nothing else that can give you confirmation ever. So when you're looking to trade, you want to have an idea of who is in control of the price. And that is the underlying foundational question to proof, and then having precise entries. So the only way you can have a precise entry is by having a good idea of what the market's telling you to do, right? So what is the proof? You have to read the proof. So your job as a trader is to almost be a forensic scientist at a crime scene. Right, so when a forensic scientist goes into a crime scene, he is not looking at every single square inch of concrete or land, right? They've taped up the entire region, yes, but they're only looking at specific areas where there's handprints or footprints, no pun intended there. Handprints, footprints, maybe someone left equipment, maybe clothes. They are scanning the area looking for specific areas of proof that link to the crime. Now, we want to take that same analogy and apply it into our trading, where the markets are printing hundreds of candles, right? There are hundreds of potential levels everywhere. There are hundreds of potential, key areas or key levels or whatever you want to call them, right? There are many ways. There is an infinite way you can draw trend lines, right? Because you can draw them at 61.1 degrees, 61.2 degrees, or 59.8 degrees. So you want to move away from kind of guessing and gambling to literally positioning your trades, reading price, and then reading the proof of the market. And so in this region, there was real proof. There was real proof that the market wanted to go higher. Real proof, right? Actual real proof. And I'm going to show you how you find that real proof. So the way we do that is I use something called the TRAP framework. So TRAP, a short kind of way to remember TRAP is trapped reactions at price. Or the longer acronym I've created for now is T stands for trapped traders, or traders being rejected and absorbed, and we see a pressure shift. So traders getting rejected and absorbed to get a pressure shift. That's what the TRAP framework stands for. Now, how do we know who is being trapped in this level? So this is the proof of the market, right? So first of all, we want to look for what was going on in the level specifically. So we want to look at here. This is very important to understand right here. Now, this candle here, this break candle, is also very important, right? So we're going to focus here mainly on this specific region here. So I have taken a screenshot of this, so I'm going to get it up right now. So here we go. So as you can see, my execution was at 68.42, right? And stops were at 32. So 68.42. So let's kind of break this down. 68.42, and my stops at 32. So here was my execution. There we go. Right? Actually, no, my execution came here. 62.42. There we go. There was my execution. Now, why would I execute here? So in other words, what I'm looking for is I'm looking for trapped traders, right? I'm following the TRAP framework. So again, TRAP. That's the TRAP framework. So maybe take a picture of this or write this down. So what does the TRAP framework represent to us? So there we have the candle right there. That's your retest candle right there. Look at that. Now, we saw, hopefully you can understand by now from the reading chapter, when you see the bid being a lot greater than the ask, that literally means that there are more aggressive sellers than aggressive buyers, right? The word aggressive is very important. There are more aggressive sellers, so the left number is greater than the right number, and we can see that right here. Now, candle by candle, we can see that right here, right? So where I have circled, where I've kind of highlighted in yellow here is the same as what's going on over here. Now, when I'm executing, right, I'm looking for a break and retest, and so I have a separate model for that. I call it the B.O.L.T breakout blueprint. That's a separate model. I will come on to that in the next 5 minutes. But before we understand breakout models and how you want to trade and all that stuff, you want to get confirmation. And so the only way to get confirmation in the market is by really focusing on who's being trapped, right? Once you understand which player or which participant is being trapped, you just trade in the opposite direction. So what's really going on here is if we break down the TRAP framework, what we have is we have traders, right? Traders, let me make this a bit smaller. So we have traders, reactions at price. Yep, that's what it stands for. So traders or trader reactions at price, and they need to be trapped. So in other words, what that means is there are lots of sellers over here. There's lots of aggressive sellers over here, but the market could not break below this zone, right? So this zone here at 68, 29, 30. We couldn't break below that zone, right? So there were loads of sellers here, and we broke above that zone. We did not break below this zone. So this zone over here, right? Who was in control, right? Who was trapped, right? Who was trapped? So the sellers were trapped, right? Because we can literally see that, right? Who was trapped? Always ask yourself that question. The sellers were trapped, right? So if the sellers were trapped, we should be buying, right? So that's what gives you your daily bias. I don't like using that phrase. That's what gives you your in the now bias, because what you've done is you've positioned your trade, you've read the real-time price action, and now you've confirmed it with market proof. Market proof is who's being trapped. Now, the final thing is an entry model. So there are lots of different entry models you use. I use a very simple break and retest. So a break and retest looks like this: break, retest, enter. So if you're stuck on this, I want you to break it down like this. I've made a framework for this too. And so the framework looks like this. I call it the B.O.L.T breakout blueprint, right? The B.O.L.T breakout blueprint. So what B.O.L.T stands for is you need a break. Now, having a break is very important. I'm going to explain to you why that is. The reason why having a break is so important is because we want to see price really blowing past this level. We want to see conviction. We want to see price breaking above that level. The reason why is because we just went through on the previous day, sellers were in control. So here, I'm going to write PS, which is passive sellers, right? When passive sellers are in control and we break above the zone, that means these passive sellers over here, they showed up over here. They did not show up over here because we see a break above the level. So this shows us a weakening of those passive sellers, right? Now, once you have a weakness of those passive sellers, what you want to focus on, or what you want to kind of dive into, is the second part of the model. So break optimal retest. So this, in other words, stands for this bit here. So this bit is the optimal retest area. And so what that means is price returns to the level of supply/demand. So here we see break, that's kind of 1. So this is the B, that's the B. Now we see the optimal retest, that's O, right? Now what we're looking for, L, is the liquidity absorption, or in other words, absorption, right? What liquidity is being absorbed? Is it buy liquidity, buy side liquidity, or is it sell side liquidity? So here it is, as you can see, sell side. So it is sell side liquidity here. And also this second bounce here, sell side liquidity, right? And then we see price obviously melting to, rallying to the upside, right? So the only reason, so this is BO, liquidity absorption, and then we pull the trigger. That's the B.O.L.T breakout blueprint, right? Hopefully that makes sense. So I'm putting things in acronyms and frameworks so people can understand them, but that is essentially how the trade actually worked out. So it was a very good trade. If I just break this one down, it was a fantastic trade. Entries at 68.42, stops below 32, and we really rallied all the way to quite a decent amount, about 2.5, about a 2 risk reward, right? So made about 1300 on the day, 1372 for the day, you know, with a 10-point stop, about a 25 point reward, something like that, just off here. And obviously I usually do trail out. When I see ranges like this in chops, I normally do, you know, pull out my position. So that's kind of what I wanted to go through today. So I'll finish off on this note here. So I'll finish off by explaining to you that what I've been through briefly today was the premium footprint execution process. So the premium footprint execution process is the 4 P's to profitability. So positioning, price, proof, and precision. So you want to have good positioning. You want to back it up by having a good read of price, not trying to predict it, actually reading it. Then from there, reading the proof. And then from there, you can start to have precision entries, which is what everyone wants. And so the biggest mistake I see is that people focus on having a precise entry without understanding the 3 things that come before it. And so if you keep making those mistakes, then you are less likely to succeed.